When I graduated high school, and supposedly I graduated from a good high school in Barrington, Illinois, I graduated with a fifth grade reading level, which apparently no one caught that problem until actually I was in college, and it was a history teacher who actually said that he thinks I have a learning disability. But even then, it wasn't diagnosed. It makes sense why I like price charts. My brain thinks in images, it thinks in pictures. When I look at a price chart, I can see what is happening. There's some interpretation of understanding, but if the price is going from lower left to upper right, I know the stock, the ETF, the fund is going higher. I don't need to read news about it. And when the price chart's going from upper left to lower right, I know there's probably something wrong with the stock. So I fell in love with price charts in my teenage years, and I've been kind of hooked ever since. So the last 10 trading days has created a very interesting formation. It's one we do not see that often in something as big as the S&P 500 index. This is a gigantic index that is 17 or $18 trillion in size. You see this formation in smaller ones, but smaller stocks. I mean, the index is not a stock, but smaller market cap price charts. So what I want to do is I want to talk about what is actually happening, and not what will happen or what should happen or what China should do or is doing or is not doing, or what Obama is or is not doing, or what the Fed should or shouldn't do, or the European Central Bank, but let's just look at what is actually happening and look at the price charts to have it tell us. Now, I've got some a fun title for this podcast with you because it's what I immediately think of when I see the price charts. So I will get that to you also. Hey, everybody, this is RC Peck, and this is my weekend podcast. And the theme for this weekend's podcast is Coiled. And I thought it was very important that I find a really, really good picture to balance the fear that is out in the world. Yes, this is a coiled snake, but it's like a sock snake. It's a very friendly looking snake. And when I put the phrase coiled snake into Google and hit images, there's lots of crazy, weird, dangerous looking coiled snakes. And the reason I put this image on here is because there's so much fear that gets propagated, is that the right use of that word, onto us by the news media and by blogosphere and newsletter industry. That's like, hey, this is something that goes on sometimes. In fact, it's been going on for about 150 years in this country, and that is sometimes the market corrects, sometimes it falls. So my theme is Coiled, and I want to do something slightly different today in this podcast. Instead of having static images, what I want to do is go into my charting software and kind of do this live for you, though this is recorded, but you get to see me do it live, and look at the price charts. So let me go ahead and just pull up, which I already did, the S&P 500. So what you see on the screen here is the S&P 500. I have a horizontal line here. This red line right here is the 200-day exponential moving average. And if you look at it right over here, I can zoom in a little bit more. If you can see this, though that does not seem significant, the fact that the 200-day exponential moving average is falling is not a trivial event. It's actually a pretty big deal. The market has been going up for so long, 6 years, and this is the first time in 6 years that this 200-day moving average has started to fall. So 200 days, that's 200 trading days. So what this 200-day trading, this 200-day moving average does, it just takes the closing price of each day and plots it. So it's a pretty big deal to have it change directions, and it has changed directions. Now, will it move back up? I don't know. But this is the S&P 500. This is the fall it made, and the market has been coiling here. It has been deciding which direction to go, and it doesn't know. So what I want to do is, rather than say, well, I think it's going to do this, let's just talk about what it has underneath it down here and what it has above it. So when I look at this, the first thing I notice is there's this support here, which means buyers came in at this price, back in October of last year, and buyers came back in about 3 weeks ago when it fell. So there are buyers down here. So that's good if you don't want to see it fall. But then I go up here and I see a lot of what I would call sellers or some resistance. So there were sellers here back in July of last year. It tried to get above this price point, and it kind of did, but then it failed and it fell back down. So there were sellers that came out again. It broke above, and now those sellers became buyers. You had buyers, you had buyers, you had buyers. So this is support for the stock market, whereas before it was resistance. But now it's resisting again, meaning it's like a ceiling that when the market gets up to, it's like, no, I want to get my money back. I want to get out, and it's pushing down. So you have this resistance right up here. I also see this other resistance up here too. So there's two sets of resistance lines that are in front of the market from going higher. Now, yes, it can go up in here, but it's going to hit these resistance lines. Now, the last resistant line would be, let me just get another one. The last resistant line would really be this line up here until it breaks two new lifetime highs, which it did in May. There's its lifetime high right there, which is very impressive. In 146 years of it being around, it's never been that high right there. But right now, between that point and that point, there's a loss of 12.5%. So we have a lot of resistance above it, where if the market moves up, there's going to be buyers coming in. Now, that could stop. It could push through there. We don't know, but there is resistance above it, and we have this kind of support down here right now. And I will tell you, China is doing everything to get this thing to move higher. They'll maybe bring out some more guns, and the fact that it really hasn't moved it higher could mean two things. One, it's failing. Chinese policies are failing to move its stock market higher. Or two, the market would have fallen much worse, but China's helping it out. So right now, the market is really coiled it's stuck between, let's just call this 2000-ish and 1860-ish. It's coiled between these 2 points, deciding which direction to go. Now, if I were to zoom out, and I am going to zoom out, we have this line down here. And let me just zoom out a little bit more and go to, here we go. So this line right here that you see, which goes across the whole screen, and now we're looking at the S&P 500 way, way, way back to 2002. This is the old high in 2007 and 2000. So if the market were to fall from that May high to this low, that would really only be about a 26% fall. And considering that the market went up about 220%, not counting reinvested dividends, a 26% fall is not a big deal. I mean, let's not be emotional. If we could set aside the emotions for a second, if something goes up to plus 200%, one would expect to see some corrections. Let me get rid of this average, this moving average, because this moving average here is no longer the 200 day. It's actually the 200 period. So, what we have here is where the market could go. Unless something really catastrophic happens, I do not see it going below the high of 2007, which had a double top here, and again in 2000. But that's where, there's not a lot of support between where it stopped. It's October low right there, and I'll zoom back in. There's not a lot of support below this, so it could fall below that. But again, we don't know. I'm not saying I don't know which way it's going to go. I do have the market probability, MPX, market probability, and that's telling us what we should do based on 150 years of math and history and statistics. And that's the strategy we're using to stay on the right side of the market. So I will keep you updated with that. But right now, the market is coiled and it's deciding. It does not know. It does not know which direction to go. And we have resistance above it, and we have this major support here. And then below here, we have this really big support down here that will probably, if it does decide to move lower, this support here is where it would stop. But most likely, and this will be the last thing I'll say, most likely if it does move down, it will retest this low right here. It will retest it to see if buyers come back in. So that's what we have both above the market as kind of overhead resistance, like a ceiling or ceilings above us. And then we have these floors underneath us. And right now from the high in May to this low back in August, that's about a 12.5% correction. So percentage-wise, well within the world of correction. But the fact that the majority of it happened in about 4 days, that was very violent and not expected by many people. So the question is, what is the takeaway? What do we do from here, RC? Well, the first thing is, and you may not like to hear this, but your strategy determines your outcome, not the market. The market's going to do what the market does. There's volatility cycles. There's trend cycles. We have been in a volatility cycle since the year 2000. We are still in it. So your strategy determines your outcome and not the market. And it's my hope that giving you that longer term view, which I did 2 minutes ago, going back to 2002. If you didn't notice, over time the market does go higher, and it does it in a way that brings with it the fewest or the least amount of investors, and that's how it's always done it. Hey guys, this is just another step in helping you protect your future and protect your portfolio. Until next time, this is RC Peck.